Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey. My guest today is Weso, right, of Beefy Finance.
Yeah.
Weso. And first, though, a shout out to MEXC. Use my code in the YouTube show notes when you join and get up to $4,100 bonus when you do. It's good for you. It's good for me. So go ahead and do it today. So hello, Weso. Good to see you, man.
Yeah, thanks for having me.
And I screwed up the time today, and Weso was just super kind to just sort of jump in 3 hours late anyway. So once again, dude, my thanks to you.
No problem. I was up. Watch the market. Bitcoin's up. Everybody's happy.
Yeah, the market's a little happier than it's been in recent days today. So that's good to see.
Yeah, you get
actually,
$100.
Yeah, actually all year. Yeah. So 2023 is off to a good start. Thank God after the destruction fest that was 2022, right?
Yeah.
So are you the head guy at Beefy Finance, or are you one of sort of a cabal of beefy folks?
No, one of many contributors.
One of many, okay.
Yeah. Beefy has a unique story. The founders aren't with Beefy anymore. They started it in 2020, like late 2020. I joined a few months into that, just as like a contributor, developing some strategies and stuff for Beefy. But the founders left sometime into 2021, and actually the core contributor team took over. So right now that consists of like 18 different people doing a bunch of different things for Beefy and helping me make Beefy what it is. So my role is like leading developer operations, head of strategic partnerships, trying to help push us in one aligned vision, which is something sometimes DAOs sort of lack because yeah, everybody's just kind of working at their own pace, doing their own things, and there's not a whole cohesiveness. And so that's also part of my responsibility is making sure we're all kind of working together and building at common goals. So
very cool. So let's back up for a second, because I usually like to, on this show, I like to explain this stuff to people like they're 10.
Yeah.
Because I'm hoping that this show attracts an audience of people that aren't from the DeFi world, but are sort of curious about it. But at the same time, people who are in the DeFi world aren't totally bored by us, talking like people are 10. So let's just start here. What is Beefy? And I know you're going to say it's a yield optimizer, right? And so let me try the dopey explanation first. So basically, if you don't know what all this DeFi hocus pocus is, you can go to Beefy. And Beefy just says, look, just give us your money, give us your crypto. We'll put it in a vault, just stake it with us, and we'll estimate how much APY we can make for you. Don't worry about how we're doing it. We're going to go off and we're going to deposit these coins somewhere, and it'll be another DeFi protocol. So it won't be, it's not like a Celsius thing where they're running around being idiots with it. You are stacking on top of other things which are DeFi and are governed by code and smart contracts, and therefore theoretically cannot be dishonest. It can get hacked, but it won't be dishonest. It'll do what it says it'll do. And then sometime later, those people can come back and reap the rewards of DeFi without really understanding much else other than how to deposit in Beefy. Is that correct?
Yeah.
Okay, good. Just want to make sure.
Yeah, so Beefy is DeFi simple, DeFi easy. And so I think that's why, we sort of like break down some of those barriers when somebody comes into, trying to get started with like yield farming. First, there's a whole lot of user action that's sort of required. So there's a lot of things you have to learn. And we try to eliminate a lot of those steps. But also just making like the whole like process of farming and harvesting the rewards and making, generating compound interest all easy. Beefy is a set of basically automation contracts. So we build on top of other DeFi ecosystem projects. So whether it's an exchange or a lending protocol, anywhere there's like sort of a yield, we'll go ahead and build on top of that like this automation script. And all we're really doing is we're harvesting that yield, which is usually in a governance token of some sort. And then we're immediately selling it, creating whatever you deposited. So if it's a liquidity token or if it's just like converting it to, let's say, ETH or something that you deposited, converting it to that asset and then redepositing it into like the position again. So it's creating that like compounding loop. So we take simple interest and then make it compound interest. And for you as a user, all you have to do is really kind of deposit into Beefy, and Beefy does all the hard work.
Yeah, when I first encountered Beefy, it was on Binance Smart Chain. So it must have been like, I think it's right around the beginning of Beefy history, if you will. And I was using, can't remember what it was. It was either Pancake Swap or Uniswap or something like that. And basically, it couldn't have been Uniswap because I was on Binance Smart Chain. It must have been Pancake. And I had some liquidity tokens, some LP tokens on Pancake. So I deposited sort of one half one token, one half another token, and I was getting rewards of transaction fees, and I was also collecting a little bit of Cake, which is the protocol token of PancakeSwap. And lo and behold, I found out about this thing called Beefy, and I was running in there, just to finish the explanation, I was running in there and by hand harvesting the Cake and selling it, and then splitting that up into the two tokens by hand and reinvesting in it. So basically, so I could get that compound interest going. But I had to do all that by hand, right? And you can only do it like 2 or 3 times a day. It made sense to do that on Binance Smart Chain because the gas fees were so low. Whereas on Ethereum, that made 0 sense. It made no sense at all to do it on Ethereum because the gas fees were too high. You would spend more you'd spend more compounding by hand than you would actually make in doing the compounding. But on Binance, like since it was so cheap, it totally made sense to do. And Beefy came along and said, "Hey, we'll just do that for you." And that was sort of my first introduction. I was like, "Oh, it's an auto compounder. That's pretty cool."
But I mean, convenience, right? Like
yeah.
Even you say like gas fees. They obviously on Ethereum, it's tremendous savings to user for us to just socialize that whole cost against all the vault users.
Yep.
But the convenience factor, like. When we talk about how incredibly difficult what you're doing is every single day, I mean, it's like you eat up 20, 30 minutes of your day, essentially harvesting those rewards and then selling it for equal halves and then putting it back into your position. And so, yeah, you can do that, and there are still people that do that, but everybody kind of errs on the side of convenience, right? People would rather just have something convenient for them, and they'll pay a fee for it. And so we obviously found that as a tremendous market fit, and we've been able to expand that product offering, no matter like the transaction fees on whatever chain. So we're on Optimism, Arbitrum, BSC, Ethereum, pretty much anywhere there's some sort of a user base that would want to utilize our product. But every single chain we've gone to, we found a pretty decent user base of people who want that convenience. Go ahead, continue.
Yeah, without a doubt. If you've done it by hand, if you've hand cranked it like I have, it's it's like the difference between washing your clothes by hand and somebody shows up with a washing machine. You're like, oh my god, this is like so much easier, right? You don't really appreciate it until you've hand washed clothes, right?
I mean, how many steps is that? Even entering into vault positions, like if you're going to be a yield farmer when it comes to like AMMs, it's every time you want to move a position, it's incredibly difficult. And so I think that there's a huge opportunity for us. To even make that easier for the users as well. So like just even leaving your positions to move to new positions should be like one-click transactions, and we can kind of like extract away all of those excess things that you have to do and make it so much easier for you as a user that you don't really have to leave Beefy. You just come to Beefy and move positions on Beefy and can go about your day, and we save you all that time. Just
one-stop shopping. It's like a mall.
That's right. Yeah.
It's like the mall of DeFi. Yeah, no, totally love that. The only way it could really be easier actually is if you had somehow where I could swipe my credit card and enter into vaults on Beefy Finance and then exit back to my credit card again. Like that, if you could do that, then it would be available to actual consumers, real people in the real world, as I call them, right? Not like you, me, and our friends. So, do you have any plan? You guys must have thought of that, right?
Oh yeah, so there's so many different aspects of where we can kind of make things much easier. So one thing is we're so multi-chain, right? So we're on 18 different blockchains. I'm a yield farmer, and if I'm on Optimism and I want to go to Arbitrum, it is a pain to get there out of my position on Optimism, move it over to Arbitrum. So even we were just talking about compounding your position, a lot of transactions. But if you wanted to move out of your position, you basically have to completely exit that to some token, find a bridge, make sure that you're doing proper or looking at the bridge rates, right? Making sure you're getting the best rate on wherever you're bridging your tokens. Then you have to wait, and the tokens have to get there. Then you have to re-enter your position again, and so it makes it incredibly difficult as like a cross-chain yield farmer. So we've noticed this as well. We're working on essentially like one-click deposits cross-chain. So you're on Optimism, bam, one click into a vault on Arbitrum or wherever you're going to bridge your tokens or BSC. And then we also are working with fiat on-rampers. So, essentially doing the same thing, right? If you want to on-ramp with whatever the fiat on-ramp provider is, being able to then, utilize their services where essentially they're hooking into Beefy Vault and being able to do one-click transactions, utilizing our new, actually DEX aggregator Zap feature. So, we definitely been working on it. There's a lot of hills to kind of climb here, but I think 2023 will be the building of making things much easier on the DeFi side for Beefy.
Now, for the people who don't know your product and who haven't used it and don't love it like I do, just speaking very, very plainly, what are sort of the yields that I can get using your product? I know it's kind of a range, but give me sort of, average, sort of what's the high, what's the low, that kind of thing.
Well, it depends what kind of farmer you are. Are you a gen volatile asset farmer or are you a stablecoin farmer?
Let's say stable. We'll start with stablecoin and we'll move up to degen for now.
Yeah, I mean, the yields weren't where they were back in when you were farming on PancakeSwap when it was 1,000% APRs and
I think but they collapsed really fast. Even back then, I knew it was bullshit. It would last for 5 minutes.
It was pretty fun for a while,
yeah.
And everything was popping up new, and it was pretty much like the whole food craze, right? So every sort of food item that could be turned into an exchange happened on BSC back then, and they were all offering amazing APY.
Yeah.
Nowadays, it's a little bit, or it's a lot of bit more competitive. So yields are a little bit lower. Obviously, the asset prices have decreased. So if you're giving somebody a governance token as a reward, and that asset is decreasing value a lot, then obviously the yields aren't going to be as good. But I think we're looking at depending on what kind of stable you're looking into. I mean, anywhere from 7-8% on USDC USDT pairs to if you're going to do more riskier stable options or over collateralized stable options, getting into 15-20% range. And then
that is incredible.
Pairs, yeah, the power of compounding, right?
Yeah. No, that is. I think a lot of people don't realize that you can realistically get that without Anchor hocus pocus, right? Because Anchor on Terra Luna was 20%, but basically Do Kwon just had little money printer, and that's where it was coming from. So you're not doing that. You're doing something very, very different.
Realizing that reward or that compounding immediately. So when you're depositing into Beefy, let's say you're farming USDC USDT, you may go to the underlying platform and you're earning, let's say 15% APR or something, but you're earning it in this governance token, right? Your risk is that token is going to go up in price or it's going to go down in price. So you're kind of playing this gambling game of, okay, well, my APR right now, as I'm receiving this token, is let's say 15%, but if that token goes, 50%, 75% down in value, then really I was never actually getting that APR, right? Beefy automatically locks in that APR. So when you're on Beefy, because we're selling that token immediately and converting it to stables, that means that you're realizing all of that APR and it's real. It's not just this volatile reward asset that you're not sure what the value is going to be in a few weeks.
Right, you're cashing out of the governance token multiple times a day. So if you're a governance token, you hate this because there's all this sell pressure suddenly on you.
Yeah, from the sell pressure side, maybe it's something that they have to deal with. People are doing this already anyways. If you do the analysis of the wallets, I mean, if they're not doing it on Beefy, then they're doing it themselves.
Yeah, sure.
So for them, it's more of Beefy creates sticky liquidity and marketing. So a lot of times we partner with a lot of the different AMMs because people deposit in Beefy and they tend to leave it for quite a long time. So it creates more of that sticky liquidity and people kind of getting in and out on their platforms. Also, we have 18 different blockchains of users. So especially newer AMMs, it helps amplify them to maybe users from different networks. So they're very friendly with Beefy. We have a lot of partnerships with different exchanges. So though we do obviously have sell pressure, we're able to offset that with some of the other things that we're able to partner with them and try to work to also help them in that regard too. So we've done some liquid staking versions that are rebuying their token and stuff like that. So
Now, do you guys talk about the underlying strategies of your vaults, or is that like secret sauce?
No, everything's open source at Beefy.
So we can see it all, right? That's
I
imagine
everything. Actually, I think our repo has been forked like 350 times or something like that.
Holy shit! I didn't realize that.
Yeah.
Yeah, I knew there were some projects on Phantom that had forked you guys. So I'm pretty sure it was you guys. It was either you or Yearn. I'm not positive which one, but
Yearn's a little bit tougher of a fork because I think majority of folks have forked Beefy, just because of the complexity of the contracts. Yearn has a lot of multi-strats and stuff like that, whereas Beefy is just simple auto-compounding strats. So a lot of times we see a lot of forks with that.
Wasn't aware of that. Okay, so that's the big distinction really between Yearn and you guys. Yeah, that makes sense.
Well, that and then for forever they were just on Ethereum, right? Or they were starting to make their foray into like Phantom, and I think they're maybe on Arbitrum or Optimism now. But Yearn also like specifically likes to go after like single assets, and then utilizing obviously maybe like optimizing where they're going to place the assets into like different lending protocols to get supply side interest or something like that. So optimizing from that lens, whereas we're very isolated to specific yield opportunities, and that's what BP sort of does. And we're much more expansive, so we'll do all the LPs and everything like that.
Okay, so for someone who says, getting 15%, 18% APY on stable coins, that's just bullshit somehow. I don't know how, but somehow that's bullshit. What do you say to that person? Like, how are you doing that?
Yeah, I mean, we're literally every day, selling the rewards. So is it sustainable? Maybe is a valid argument.
Well, you guys are. Well, you guys are. So you take my stable coins. You go where to Curve, like in general. So it's Curve is where the bulk of it's coming from.
No, I mean we're on. We have hundreds of different partners. So Curve, Velodrome, Balancer, Beethoven X, Pancake Swap. Anywhere there's a possibility of a reward being emitted, we're able to then go and optimize that yield. So. It's solely dependent on the underlying farm.
Okay, so it's a lot of it's governance tokens. So you get the transaction fees, obviously.
Yeah,
but so that's
a lot of times you get the trading fees. Besides, like some of the solidly forks, which you actually don't earn trading fees. Those go to the.
Oh, I didn't know that. That's good to know.
Yeah.
So you do get the transaction fees, and then on top of that, you get the governance token rewards. And is that where the bulk of the APY is coming from? It is.
Yeah, these exchanges have to have liquidity to function, right? And deep liquidity, or else they're never going to get routed trades, and they're never going to make income on fee revenue. So they need deep liquidity, and in order for them to compete for the deep liquidity, they have to give you a decent amount of rewards. And so we're able to, obviously take advantage of that by building automation on top of that and basically converting all those governance rewards to the underlying.
Got it. I wasn't aware that you could make that much off of just governance token these days. I thought like the governance, Curve, and there were some exceptions, but I wasn't aware that sort of broadly the governance tokens were still valued even that much.
Well, there's always something going on. So actually, if you look at a lot of the unique opportunities now, like on Optimism, a lot of it is part of like their Optimism Summer program. So they give a lot of grants out. So now each of these independent protocols that need liquidity for their tokens have been giving rewards in Optimism token. So it hasn't necessarily been their governance token that has been being used as like the reward. It's been more of like OP. And then you have other like providers like Lido, who really need deep liquidity for wrap stake ETH, wrap stake Matic. And so they'll provide the Lido token as a reward, and they'll do that as like a permissionless gauge reward on Curve. So it's not necessarily like just the Curve rewards, even though like there's obviously the Curve wars and the voting. The same thing with Balancer, the Balancer wars and voting, where Balancer gets emitted and Curve gets emitted. But a lot of the independent tokens or protocols that are looking to get actual deep liquidity for themselves are providing their own token. Their own governance token in order to help incentivize that liquidity, and we've been able to kind of build on top of that as well.
Got it. Okay, and then so we still haven't covered in the degen category. If I'm crazy Ivan, what can I kind of get on sort of the higher percentile vaults on Beefy Finance?
Yeah, it'll be interesting.
I won't hold you to this, just in general.
I mean, like we just had, I think, is that Swapfish or something that launched on Arbitrum,
Yeah.
which had like ridiculous like yields. I mean, even stables were earning like over 100% for a few weeks.
Wow.
And, I think every time there's a yield so high that we don't have a number for it, we actually put like the fire emoji.
You're just like, I don't know, it's huge. Whatever it is, it's giant.
Yeah, but I mean, those are all very temporarily. It's usually part of like new protocol launches. So whenever the AMMs sort of initially launch their token, they have a really high emission to sort of like drive up. It's essentially basically like a big marketing ploy, right? So like you drive all of this TVL, you drive excitement, you drive volume through your new protocol by offering extremely high yield, and then it essentially like the curve as it goes down the curve, it dies out a little bit and normalizes. But yeah, so that's what we usually see. But if you go to NOW Beefy, it's probably somewhere in like the hundreds of percent APY or something like that. That's probably the highest.
Wow. Okay. So that's sort of the high end. Yeah, I remember. I mean, even back in DeFi summer days and all that, we were seeing crazy percentages, but they would drop really fast. So I put some in, I'd be like, oh my god, and then like next day it'd be like half, right? And as more liquidity filled up, it sort of fell off a cliff at a certain point. But even still, like even being off a cliff was still pretty good. It was still a lot higher than 20% most of the time, right?
Yeah,
it was still like 60 or 70%. So. Yeah.
Yeah, there's very specific. It's sort of like we've always had like this. I guess this like debate about some of those really high yields, right? Because they're really tied to like new token launches and people sort of like buying up the token, and it hasn't actualized its true value yet. So it may like skyrocket way higher than it should because everybody's sort of like getting in and everybody needs a share of it. And the yields are really high, and so it kind of creates like this, spiral. And like okay, people got to buy it, and then the yield's really high, and I want to see it actualize the yield, so I need to buy the token. So like the price appreciates pretty quickly, but that's where sort of people sort of can get burned because at some level it's way overpriced, and people were just kind of buying it up to chase the yield, and then it starts to fall out in value, and then the yield starts to die off, and then it's the downward spiral. So unless you're an advanced DeFi user, I'd stay away from all those like new token launches because you have to know how to play that game, or else you kind of get burned.
Yeah, I've been long out of that game, so I don't even touch. I see some token like Wiggly Finance, like I've never heard of before. I'm automatically out pretty much at this point. So
yeah, I mean I stick to staples, right?
Yeah, exactly. So or I mean honestly, the game I'm playing right now is just don't play the yield game. I'm going for low caps that have some significant promise on the upside, and generally things that have been around for a while that don't have like a giant cap. Like for example, your cap right now is just a little bit under 30 million.
Yeah.
Right, and which is crazy because you're an established, well-known protocol. You're on 18 chains. You have a $200 million TVL, and 30K is like, or sorry, 30 million. Seems like a steal to me, right? So,
yeah, I mean,
yes. So I, just putting it out. Not investment advice, but to me, that's a steal. So yeah, I bought a little bit of Beefy, absolutely. So that's one of the reasons I do this show is to notice things like this. And as I start poking around, I'm like, oh my god, it's 200 million TVL, but it's only worth 30 million on the.
If you start to look at the other like yield aggregators inside like market cap to TVL ratio. We're pretty low on that ratio, so I'd like for me personally, I feel it's undervalued, but I'm obviously building Beefy.
Bit biased. So. That's okay.
I have the bias, yeah. But we're like Beefy's, unlike some of the other tokens, Beefy's emissions are done, right? Like it was fully emitted within 30 days back in 2020. So there's 80,000. There will only be ever 80,000. So there's no sort of like increase in emissions that's going to increase the market cap. We deliver some of the fees back to like Beefy stakers. So there's a use case for it beyond governance. So in general, like we feel pretty good with our tokenomics, and I think we're just kind of like sitting in the same realm as everybody else, right? With this sort of market where just organic buy pressure is really not there. So.
Yeah, so let's actually go over the fee. So like, the old question, how do you make money? Yeah. Right? So you guys make money because there's big rivers of money flowing by you, so you dip a little straw and you take a little bit as it goes by. And from what I can tell, it's between 4% and 10% fee that you guys get, that you guys take off of whatever you make. And 3% of that, roughly, goes to the Beefy stakers. Right? Is that correct so far?
Yeah. So our original fee structure was 4.5%, which was okay when the market was a bull market, everything was fine. Managing the team was a lot lower cost. But then the bear market hit, and it just wasn't cutting it anymore. So we weren't making enough to exceed our burn rate. And we needed to make a protocol change. So back in June, we actually passed a proposal to increase our fees to 9.5%. And that was part of our sustainability, as we knew that we were going to have a bear market coming up, and we needed to make sure that we had enough runway to keep developing the product. And so with that addition, and then being able to cut some of the team costs back in June, we were able to essentially get us to a position where we're not really even burning any treasury. So we've been doing pretty well.
That's great.
But we've had to sort of get us there, and we had to make sure that the DAO was, when we were kind of passing that proposal, there was a lot of pushback on whether or not 9.5% fees is going to be too high. We looked at all the competitors out there. Yearn at the time was 2 and 20. Yield Yak on Avalanche was 10% fees. Everything on Zon Ethereum, right? Harvest, Pickle, all of those were 20% fees. So at 4.5%, we felt like we were way undercutting the value of the product itself.
Totally.
So now at 9.5%, we're still not really even above a lot of our competitors, though there are a few. But we try now to deliver the best possible product we possibly can, and so that would obviously be the justification for the fees that we charge.
Yeah, so 2 and 20 is typically what hedge funds and venture funds do, for those who don't know. So the management team takes 2% of whatever the treasury is every year. Just, we do that to manage things. And then they get 20% of the profits. So you have to first return the fund, right? So I don't know if you guys are doing that, so I'm not sure if you guys are or not. I don't know if Yearn's doing that either. My guess is they're not. It's just 20%.
Well, I think they're cutting it. So I think it's not. I don't think they're doing the management fee anymore. But that's definitely how they started, and they were operating for quite a while. We never had a management fee, obviously, but we were taking out 4.5% of the yield. And so I think we were talking about, what happens to the treasury fund. So a good portion of that now goes towards the Beefy treasury to help pay for all of our monthly expenses. The rest of it gets put into, we call it our reward pool. So essentially anybody who owns the Beefy token on that specific chain, so whether it's Optimism or Ethereum or Arbitrum, the chain, whatever the earnings are for that chain, gets deposited into a reward pool, and anybody who stakes Beefy gets to earn a portion of the protocol revenue. So it's kind of like a distribution as participating in governance, right? So.
Yeah, and there's 80,000 tokens total, and that's across all chains. It's not like each chain has 80,000 or something, right? So yeah, just make sure that's clear for everyone. Yep. That's what I thought you meant, but I just want to double check. Okay, and so what is your burn? I mean, I guess we could see this on chain, so I think it's okay if you tell me, right? What are you guys burning a month, kind of thing?
I think at this point it's $5,000 or $10,000 or something like that. So actually,
that's it.
Yeah,
$5,000 or $10,000 a month.
Yeah, you can.
That is an insanely low burn.
And we're trying to be as transparent with everything as possible. So we just released 2 weeks ago. If you go to beefy.com and you go into our little DAO section at the top, you can actually visualize our entire treasury across chain. So you'll see every single dollar that the DAO owns, and then be able to see all the spends against that and everything like that. So we're trying to also push forward and become as transparent as we can as a DAO.
That is absolutely incredible. So a couple things here. So I started life in the venture world, and I've raised money from SoftBank and Intel and Time Warner, and been on the management team of a company that raised from Sequoia and Elon Musk. So I've kind of, I've seen like what life is like in that universe, and a lot of startups. First of all, they won't even talk about to the outside world about what their burn is, and second of all, in a downturn like what we're seeing right now, like especially a severe one, most of them just die. They don't find a way to survive. They don't have revenue a lot of the times, right? Or their revenue is so far below what their burn is, and they're pushed by the VCs to like way overextend themselves. Growth over revenue. That if they suddenly hit a wall like a recession, they just can't live through it. And that's what happened to the .com boom and bust to a lot of dumb companies, but also a lot of good companies got crunched in that as well. So, whereas what I'm seeing in the DeFi world and with you guys specifically is something very different, where you guys are able to cut your burn down to something really small, and your revenue is enough to sort of keep you going. So I didn't ask you about your revenue yet. Actually, now I'm thinking about it. What is kind of your revenue monthly?
Yeah, so I think we're close to. Well, we get treasury income, right? So our treasury income is like probably 90,000, and then like everything, we obviously deliver a portion to like the BP holders and stakers, which is probably like 30% of that. So probably another 30,000 or so. And we're getting it from a variety of different sources. We've been trying to find new vectors in order to deliver revenue. So we've been doing it with running validators. We've been doing it with actually like staking portions of the treasury, so like generating income from the treasury itself. And then we convert now. And for the longest time before our sustainability proposal, we are actually earning everything for the treasury inside native tokens, which fine in a bull market, right? But when you start to like have all of those volatile assets when the bear market sort of hits, then it really kind of can deplete your treasury. So we did a conversion to earning everything in stable token, essentially because we were trying to offset our stable token outflows.
Yeah. So another question. So when I look at the Vault APY, is that before you guys take your fees, or is that after?
It's including.
It's included. So that means so you've already factored. So when it says I'm making 15%, it's not 15%. Oh, but wait, you guys are going to actually take like some of that, or your 10%.
Right. We factor it in.
Yeah. Okay. So it's already factored in by the time. So the APYs are actually what I get.
Yep.
So, and I guess that would be, that would make sense, because then you have a bunch of pissed off people who are like, wait, I'm not getting that, when they get out their calculator. I'm getting ripped off by Beefy. That's crazy, right? Which, so you guys don't want to do that, so that's good.
Our API is actually open source too, so if anybody ever, it's the best thing in DeFi, right? Or Web3. If you have any issues, you think that we're doing something wrong, everything's open source. Go look for the code for yourself. If it's something that we've missed, come put it out to us, but it's verifiable that everything we tell you is exactly what we're doing. So,
right. And when you say you take the treasury and you invest that in other protocols, that's just your money, right? So it's not like what people have invested into vaults, correct?
No. That's the DAO treasury. So what we've earned, so that
right. So that's your money. Well, the reason I thought that's what you're going to say, but I want to make sure that's clear.
It's all non-custodial, so we don't actually custody anybody's funds. The contracts kind of do their own thing. So, we're not like custodying people's funds and then moving them around the market. That would make us sort of like a different product than we actually are. We're just automation software. You still custody your asset. You get a receipt token. You can come pick it up whenever you feel like it. There's no and for most chains and most vaults, there's no withdrawal fees or deposit fees. Pretty much just enter and leave whenever you feel like it. No time lock, no nothing. The treasury I was referring to is like the actual income flow we're getting from the fees we charge gets put into our DAO treasury, and we're taking portions of that and investing those into Beefy vaults into like stable coin opportunities so that we can generate yield with our DAO treasury in order to like give us another source of revenue income.
Yeah, the reason I ask this is because I know that some people in the age of SBF, some people listening to this will have heard you said, we take the treasury and we reinvest. Like, oh my God, it's another SPF. This guy's another Mashinsky. Holy shit. Right. So I'm actually helping you by heading that off at the pass by asking this question because I know what the answer is. So, even if you are SPF and you want to get at all that money, that 200 million that's sitting in vaults, you can't touch it. There's like literally nothing. You couldn't get that if you wanted it, right? Because that's all in smart contracts.
Yeah, it's all in smart contracts. There's actually, so with Beefy, there is, we're a security-focused protocol, which I think literally should be the mantra of every DeFi protocol. But
Yes.
it's not. But we're security-focused, so, we have a strict set of guidelines in order for us to actually build on top of other partner protocols. So if you see us actually like launch something on Beefy, it's passed all of our security criteria. We look for centralization risks. We look for any sort of like weird pieces of code that we need to like have them fix. If it's just generally unsafe, we'll stay away. We look for large like holders of the tokens, so any sort of like way where somebody could just massively sell a large amount of like some token that they're holding. So we sort of like look at a variety of different things before we actually even launch the protocol or launch on top of the protocol. For like the same set of standards with Beefy, we do have a upgradability on the strategies. So technically, we can change the contract. So if like let's say PancakeSwap changes to a different master chef, without having to deploy a whole new vault and make all the users go and exit that, we'll be able to like change the strategy and then essentially just deposit it into the new master chef. Because of that, there is sort of a little bit of centralization risk because you're essentially moving funds out of one contract and putting them into another one. That is guarded by a time lock, and then it's guarded by the Beefy multisig, which is the same sort of requirement that we require all the underlying protocols with any sort of upgradability to also have.
So there is a slight risk. So you could, if you're SPF, say I'm going to upgrade this contract such that everything in the vault now gets sent to my wallet. Like that could happen, but you do have a multi-sig, which hopefully there's some saner heads on this board of people. So just to be completely upfront about what the risk is, that is a risk.
Yep, there's actually a time lock first. So first we have to register, like schedule a time lock transaction. And actually when that happens, inside our Discord, there's we use Open Zeppelin Defender, which will like then post a post in our Discord saying that this time lock transaction has been initiated. So if you're paying attention, everybody in the DAO will see that the time lock transaction has been initiated and can kind of look to see exactly what's going on. And then it all has to be verified by the dev multisig. So then after the time lock periods go, so we have checks and balances sort of in place to make sure that
you do.
Yeah.
So when you say time lock, you mean that basically, okay, I'm SPF. I have now set up a new contract that says I SPF get everybody's money. That then goes into a time lock, which means there's a time delay before that can actually execute. How long is the time delay?
For us, it's 6 hours.
6 hours, okay. So then it goes into Discord and everywhere. Everybody goes, wait, what? What is this? And if they notice that, like, oh my God, this is SPF just siphoning our funds away, they'll raise the alarm and and they'll basically put the word out, everybody withdraw your funds now so that this doesn't happen. But that assumes that the multi-sig doesn't stop it. So there's another layer of sort of a electoral college, if you will, that of sane heads that should stop it.
If you think about like the flow, right? Essentially, what would have to happen is that like there would have to be collusion on the multi-sig. So essentially, 3 out of 5 signers have to come together and say, "Hey, this is the new contract. We need to we're gonna go ahead and move the funds, right?" And then they would have to put the time lock transaction in, which would then post very transparently on the Discord, and come up, and then no one would have to question it for 6 hours, and then they'd have to go back in and then execute. So, is it feasible? Yes. The people who are on the Beefy multisig have been part of the team for 2.5 years. There's a lot more at stake than just moving one contract. But we also want to be as transparent with any sort of actions we're taking that can possibly touch user funds. So that's where we're trying to build up our processes, and everything actually is verifiable. Even if you go to our docs, you can go see who's the signers on the independently multisigs. You can look at each of the different time locks. Like I said, you can pay attention to the DAO for any sort of transactions. So trying to be open and transparent with it as well.
Okay, well, we're almost at the 40-minute mark. I've got one last question. Have you ever thought about doing leveraged vault farming? So right now, it's just whatever I put in, but wouldn't it be great if I could 3x or even 10x leverage that? Or maybe that's a really horrible idea. Have you guys thought about that, and what do you think of that idea?
No, it sounds fun, right? But I think the core thought is that like too many protocols try to do too many things, right? So I think that's where some of them really fall apart. They go, okay, I want to be a lending protocol, and I want to be the deal aggregator, and I want to be a swap, and I want to do my own DEX aggregator, and I want to, and it's just way too much. So what you end up doing is you're spreading your already thin team way too thin, and then you have to be an expert at all these different things, and you have to make sure that nothing bad ever happens in any of them, right? And so, and not only that, but you have to be really good at marketing each one of them independently, and you have to have great tokenomics for each one of them, and so it becomes a lot. And so I think a lot of protocols end up failing that way, right? They're trying to bite off way too many things and trying to do way too many things. And so I think at Beefy, we've come to the conclusion that, hey, we just want to do what we do really well, right? And that's just make DeFi easier. So what can we do to make more, give you more features, make like all the transactions sort of go away, give you all the available information on our UI. But when it comes to stuff like leverage yield farming, it starts to get out into like a whole different product. And so though it's not something that, like, let's say we'll never count out anything, right? Because it's definitely, if there's enough opportunity or there's enough users that would want a product like that, it could be something that we could do. But I think what we would rather do is concentrate on building out the product we already have and continue to make that better than to try to expand into all these different, I'd say like not core competency product offerings.
Yeah, so no beefy degen box coming anytime soon.
Yeah, I mean, it's kind of like if you look at even sushi, right? It's a great example. It's like sushi's trying to do everything. So, and hey, maybe they'll end up getting it all done, but you're just spreading yourself really thin.
But probably not. And also, you have to, the security of everything is that you can't be security focused if you're doing everything as well, I would imagine.
I mean, you can't. It's incredibly difficult. It's putting a really tall task. So.
All right. Well, Weso, that's all the time we have. Is there any you want to plug a website and a Twitter handle?
Go to beefy.com at Beefy Finance. If you want to follow me, I'm at W3SO Beefy on Twitter. I'll be in Miami coming up. I don't know if this is going to be live before Miami.
Oh, well, I'm hoping to put it up tonight. We'll see if I get to it.
Okay. So I'll be
by tomorrow at the very latest.
If it's going up tonight, big announcement tomorrow. So be super cool. So maybe we drop that.
Yeah, you're speaking at Quantum Miami, which is like the third week in January, as am I. So we will actually meet in real life there, awesome. Which that'll be great. And once again, I just from the bottom of my heart, thank you so much for putting up with my schedule mishap here and coming on last minute. Very, very appreciated.
Well, thanks for having me.
All right, everybody. My name is Mark Jeffrey. This has been Hash Rate. We'll see you next time.
Bye.